A hedge fund is an investment vehicle that pools capitals from high net worth individuals, institutions, and other investors to invest in a variety of assets, often using complex strategies to generate returns. Hedge funds aim to maximize returns while minimizing risk, typically by hedging against the market downtrends. The distinctive features of the hedge funds includes private investment. Hedge funds are not open to the general public. They require significant minimum investment and are typically reserved for accredited investors. Hedge funds are managed by experienced investment professionals. Number 3 distinctive feature is diversified strategies. Hedge funds employ various investment strategies such as long short-term equity, global macro, event-driven, activists, and quantitative methods. The fourth one is flexibility. Hedge funds can invest in a wide range of assets including stocks, bonds, commodities, currencies, and derivatives. Number 5, performance-based fees. Hedge fund managers typically charge management fee 1 to 2% of assets and performance fees 10 to 20% of the returns. Regulatory oversight. Hedge funds are subject to the regulatory requirements such as registration with Security and Exchange Commission in United States. The benefits of the hedge funds are: number 1, diversification. Hedge funds provide access to unique investment strategies and assets. Risk management. Hedge funds aim to reduce risk through hedging and diversification. Potential for high returns. Hedge funds seek to generate absolute returns regardless of the market conditions. Nevertheless, it should be noted that the hedge funds also comes with high investment requirements, risk for significant losses. Investors should carefully evaluate the hedge fund strategies, risks, and fees before investing.